for having me. And welcome also to the people joining us online from the safety of their own homes, which includes my co-presenter Sophia Omar, who got struck down by COVID this morning. So special shout out to Sophia and colleagues. So sadly you're saddled with just me today, but hopefully we'll get through it okay. So I'm Shadi Brazel. I run the place-based impact investing program at the Institute, and I'm here to make you experts in impact investing. There will be a lot of information, but don't worry, there will also be a tea break and plenty of opportunities to ask questions. We've got a kind of Q&A session before the break and then one at the end. So that applies also to colleagues joining online. I'll start with a little bit of background to the Institute, who we are, why I'm here speaking to you today. We'll dive into what is impact investing, why does it matter, and then we'll look at some of the actors in the impact investing ecosystem. We'll also do a quick run through of the Institute's main programs, pensions, financing a just transition, and place-based impact investing. Then we'll have a short break, and then we'll do some kind of myth busting about impact investing, and then on to Q&A. So, who are we at the Institute? We are an independent, non-profit organisation seeking to mobilise more private sector capital at scale to address social and environmental challenges. We have the modest ambition to change capital markets in the UK and internationally so that they're fairer and work better for people and the planet. We're also the UK's National Advisory Board for Impact Investing, and the Institute was founded in 2019 as the kind of confluence of two UK government task forces on impact investing, one led by Sir Harvey McGrath and the other by Dame Elizabeth Cawley, who's coming later on today to speak to you. So we don't manage money, but we aim to support the impact investing market to grow, not only in size, but also in effectiveness. And we're supported to do this work by the UK government, so the Government Inclusive Economy Unit, which is within the Department for Digital, Culture, Media and Sport, the City of London Corporation, and 14 financial services firms. So this is where it gets really ambitious. Before I really get going, we want to do a temperature check on everyone's understanding of impact investing. And people joining from Zoom can join in with this as well. Sophia was the real kind of brains behind the tech operation. So if this doesn't work, we'll revert to an old-fashioned show of hands. But if you could please go to menti, menti.com, or scan this QR code and enter the participation code, you should get a question. And can I get the Menti screen up, guys? Yes. It's already working. Look at this. So I'll give this a couple of minutes. Oh, blimey, this was easier than I expected. Sailing along. Yeah. Great, we've got a few more people trickling in and participating. Welcome, guys. So that's great and really interesting. And actually, it looks like we've got more experts in the room than I was expecting. So that's really positive and great that we're not kind of in a zone where people are thinking that impact investing is only for philanthropists. So that's really positive. We can come back to this one, so you can keep voting as we kind of move through the discussion. So that was a little bit of a con because we didn't give you the proper definition of impact investing. So that wasn't an option for you. So apologies to anyone who was shouting at the screen hoping that this definition would come up as something to vote for. But this is the Global Impact Investing Network's definition of impact investment, which are investments made with the intention to generate positive, measurable social and environmental impact alongside a financial return. So that's the definition we're working to. That's the kind of basis from which we're going to build. Now, God, this slide looks very bare, so enormous, but very important and enables you to focus on what really matters. So ultimately, all investments have an impact, positive or negative, or a mixture of both. And the question when investing for positive impact alongside a risk-adjusted financial return is what was your intention? Are you measuring your impact? Are you transparently reporting on that impact? And is the impact additional to what might have happened otherwise? And impact investing is about holding people and businesses to account for the impact that their capital and operations have. So when we're doing impact investing, we move beyond the traditional mindset, which considers ESG factors as a way to mitigate risk, towards actively contributing to solutions. And you can think about it in terms of the ABC. So A is acting to avoid harm, B is benefiting stakeholders, and C is contributing to solutions. And that ABC is demonstrated here as part of the spectrum of capital. So if we just pause here and take a kind of worked example, so my background is in affordable housing funding, so we use a housing investment example. So for example, you would be a responsible investor or taking a responsible approach to investment, and you would be in the A, avoid harm category, if your fund has a negative ESG screen, but the housing investment is kind of predominantly comprised of units for market sale or private rent. You'd make it into a sustainable approach and category B, benefiting stakeholders, if your investment was a mixture of regulated affordable housing and private units, but the majority was for private rent or sale. Your fund would be an impact investment, so it would be contributing to solutions, if the majority of the investment was comprised of regulated social and affordable housing, which benefit vulnerable or low-income residents in areas experiencing an affordable housing shortage. So one really good example of this is Resonance, the fund managers, have a national homelessness property fund, which is now in its second iteration. And that works by acquiring properties and leasing them to social housing sector and homelessness charities to provide individuals and families at risk of homelessness with a settled home. Resonance also supports those housing providers to support residents, to find employment, enter education, save for a deposit, and ultimately move into the private housing market with a track record of sustaining a tenancy. So that's crucial, and that contributes to solutions. Now, also on this slide, I just wanted to highlight the most kind of pernicious myth that we encounter at the Institute about impact investing. And luckily from the poll, it doesn't look like we've got any believers of this in the room. But that is that impact investing is necessarily concessionary. And it's just not true. You can make a risk-adjusted market rate financial return and create positive social and environmental impact at the same time. And that Resonance example is just one instance, but we will go into examples of investments that have achieved both of those later. But as you can see from this slide, impact investing can have a range of financial goals, from finance first risk-adjusted financial returns to impact first work, which might be concessionary. At the Impact Investing Institute, we're wanting to accelerate market growth across the board. And so we tend to work with those bigger pools of capital that focus on finance first impact investing, or the kind of green highlighted section there on the screen. So this is not philanthropy plus, it's about adding a third dimension, impact, to the risk return profile. So why is impact investing important? And I think crucially, it's because it's not just the right thing for investors to do, though it is also the prudent thing. As Mark Carney, the oft quoted former governor of the Bank of England, has recently said, the climate emergency is creating a great, if not the greatest, commercial opportunity of our age. And that opportunity is already growing. So we can see that the global impact investing market is sized at $2.3 trillion, and the UK is about 3% of that, and counting. We're getting bigger all the time. And we'll chat a little bit more about the size of the UK impact investing market shortly. But clearly, momentum behind impact investing, so putting capital to work to solve problems, is growing globally and at home, with government policies increasingly recognising the need to leverage private finance for positive impact. And the public is behind this, as we can see. 70% of people want their investments to at least avoid harm. And financial services are also on this journey. The Net Zero Banking Alliance, launched in just last year, 2021, as an industry-led, UN-convened group of banks, which represent over 40% of global banking assets. And those banks have publicly committed to aligning their lending and investment portfolios with net zero emissions by 2050. And then finally, we've got a quote here from Larry Fink of BlackRock, which most of you will know is the world's largest asset manager with around 10 trillion in US dollars of assets under management as of the beginning of this year. And he says, we focus on sustainability not because we are environmentalists, but because we are capitalists and fiduciaries to our clients. So Larry Fink is clearly of the view that the kind of importance of the impact of financial investments is growing. So the UK impact investing market is exactly this big, in answer to the question at the top of the slide. Earlier this month, the Impact Investing Institute launched the first report aimed at sizing the UK impact investing market. And these were the results. So £58 billion directly in assets under management and £53 billion in impact-aligned assets. Now, impact-aligned assets are investments that are generating a positive social or environmental impact, but those are kind of not made intentionally and aren't really being measured. So another housing example, bonds issued by housing associations and other regulated providers of social housing are impact aligned in that we know they deliver social benefits in the form of safe, secure, affordable housing. But those impacts are not ordinarily explicitly measured or reported as part of those bond issuances. So those would fall into the impact aligned category. And just a little bit on the report. So the report was based on, as the first of its kind, based on qualitative and quantitative data gathering and analysis, including market surveys. 97% of survey respondents held the view that over the past 2 years, asset allocation to impact had increased. A further 90% of the survey respondents reported that 2020 returns were either in line with or exceeded targets. So these assets are kind of performing. 75% of survey respondents are planning to increase their allocation to impact by more than 10% in the next 5 years. So the market is growing rapidly, largely due to pressure from governments, regulators, and individuals, as discussed on the previous slide. But the market is still just a fraction of global assets under management. Now, we have another little poll. So again, the participant code is different, so you have to rescan or re-enter. But given we now know that the market is set to continue to grow really quickly, who are the current investors who are actively investing for impact? So who are the kind of actors in the market? So if I could get the Menti slide. Sorry. It's going to do a word cloud, in theory. I'm asking you guys, who do you think the investors who are already active in the impact space are? And it can be specific organizations that you know, it can be kind of groups of investors, or even individuals, I guess. So who do you think impact investors currently are? Great. Now, I think in theory, if more than one person says the same thing, it gets bigger. Oh my God. Great. I mean, it's having a great time kind of dancing around. Fab. It is slightly, because it's green on green. Well, I'm going to do one of these in all of my presentations. I'm a really big fan. So if we hop back to the presentation, we'll see Absolutely. So we pretty much got all of them in that. I guess the point of the exercise, unsurprisingly, is that anyone can be an impact investor. And even currently in the impact investing market, and there are all kinds of asset owners. So we saw Big Society Capital was on there. Also, local government pension schemes are actively engaged in impact investing. Foundations, family offices, as someone said, banks, and also specialist and non-specialist asset managers. So Bridges, Triple Point, the Man Group, Foresight, lots of whom we'll talk about a little bit later. So there are kind of lots of different actors in the impact investing space. So now that we've established what exactly impact investing is, who does it, and why it matters, I'm going to run you through some of the Institute's programs, starting with pensions. So pension funds represent some of the world's largest asset pools of capital, and as long-term investors, they're often perfectly placed to be effective impact investors. Now, all pension funds largely now consider ESG factors when looking at their investment portfolios, but impact investing is about moving beyond that, so moving beyond risk management mentality into actively contributing to solutions, as we've previously discussed, and future-proofing portfolios. And we know that pension funds are already doing this, and the market is growing. So a recent survey that Big Society Capital and Pensions for Purpose did of UK pension funds, representing total assets under management of £150 billion, revealed that just over 50% of them already hold some form of impact investment. And we now know that those impact investments are those which focus on a positive social or environmental outcome, as well as a financial return. UK pension funds are increasingly taking impact investing into consideration, and 90% of survey respondents were looking to make impact investments in the UK in future, which is great news for my programme, which is on place in the UK. So organisations also like Make My Money Matter are doing some great work with individual savers and members of pension schemes. And as we saw when looking at why impact investing matters, the vast majority of people would prefer their money to do good as long as the return is protected. On a very personal level, by the time I'm retirement age, all of the deadlines for climate action that we talk about now will be passed. 2030 will be the distant past, 2050 will be gone. And I, for one, don't relish the idea of retiring into a world on fire. So I'd much rather that my pension was working to encourage climate action and improve climate resilience, as well as preserving my savings, than it wasn't. So given that importance and the massive opportunity that impact investing presents for pension funds, the pensions programme is one of the Institute's flagship projects, and it's got 4 main pillars. So the first is a legal paper reviewed by the Association of Pension Lawyers, which, just as a side note, I'm desperate to get an invite to their Christmas party, because I just think that must be wild. And this clearly highlights the compatibility of fiduciary duty and impact investing. And it's really readable even for those non-legal experts like myself. We've also produced a set of impact investing principles for pensions, which provides clear and practical guidelines on how to integrate impact into your strategy and approach. And we're also building an extensive evidence base, some of which you'll see today, of investments that create both positive environmental and social impacts alongside a market rate or above market rate return. And crucially, examples of those investments which are investable at a scale that suits pension funds. And then finally, we run an extensive advocacy programme, engaging with government, pension trustees, pension consultants, and other actors across the pensions ecosystem to educate them about the benefits and opportunities of impact investing. And this includes our work on place-based impact investing in the UK, which I run, and also on emerging and frontier markets, which is run by a colleague of mine. And all of those kind of examples of investments made by institutional investors, including pension funds. And actually, we have a video next. This is really testing the kind of technological abilities of presentations to the max, about what this looks like in action.
work that Global Parametrics does primarily focuses on climate resilience. We believe very strongly that there are no natural disasters, only natural hazards that can cause disasters due to social, economic, or financial reasons, policy as well. So what we're trying to do is we're trying to really champion the use of anticipatory financial solutions to enable communities to be able to both anticipate and be resilient to climate events.
Our investment comes from the UK government via SCDO, so the Foreign Commonwealth and Development Office, and the German government's development bank, KfW, via the Insta Resilience Investment Fund.
Atlas is a renewable energy generator looking to accelerate the transition to 100% clean energy. We've been conducting community initiatives across all our projects from the outset. Our approach is to engage with the community early and understand what needs are there, what gaps exist, and then look to invest in programs or projects that address them and look to improve the standards of the community. The organization's investment is 100% funded by Actis.
Here at Streetford Renewable Energy Plant, we are a renewable generator. We combust about 250,000 tonnes of straw every year. We run 24/7 for 50 weeks of the year, generating about 39 megawatts of power to power about 60 to 70,000 homes.
Sleaford Biomass Plant is an attractive investment to Railpen, not only because of its low carbon power generation technology, but also because of its local economy influence. So providing local jobs, supporting the local economy through community benefit schemes, and buying feedstock from local farmers.
Our view is that for a business to be truly impactful, it must be sustainable. And the only way for a business to be sustainable is it has to generate profits.
In terms of balancing impact with profit, it's really important to move away from the more sort of traditional binary view that these are mutually exclusive. You know, it's become ever more prevalent in the culture for investors to think not just about returns on capital, but to also think about the impact, the social good that your investment can have.
Our goal here is to try to push the envelope for a more just transition. So we're passionate about that endeavor. At the same time, we have to acknowledge that if we go out of business, our ability to influence goes to zero. And so that's the balance we constantly need to strike.
Practically, to maintain this balance, is good to have sort of reporting and monitoring systems and a key impact objective that you're working towards.
So the low carbon transition is the first time in many decades when governments, policymakers, regulators and investors are all aligned together to fight climate change. Investors should make use of the significant available resources and technologies, frameworks, methodologies and data to build their climate risk and engagement capabilities. This will help make their portfolios more climate resilient, allow them to capitalize on low carbon investment opportunities and enable a just transition.
The investment choices you make are dramatically important because they shift major capital flows into desired directions.
But it's important to note that these investments cannot just have a basic social impact metric that they can reach. They can really drive forward systemic change and try and sort of resolve or try and mitigate these key issues that are currently being faced by our society today, such as climate change.
We want to really be a force for good in the world. That's how we describe it, that's how we see ourselves. We just came up with our sustainability report. And when I read through that, it almost like makes me get very emotional because if more businesses, if more business leaders would do this, what a different world we live in.
So you guys are already taking action by becoming experts in impact investing and attending bootcamp. The thing I really like about all of those investments mentioned in the video are that while some of the kind of narrative focused on the environmental benefits, partly because the video was made in advance of COP26, all of their impact, they also have really great social impacts, whether that's kind of generating high quality jobs or delivering educational outcomes all over the world. And it provides me with a very neat segue that meeting of the potential social and environmental benefits of investments into the just transition, which is mentioned in the video, but is the concept, the imperative really, that the transition towards a net zero carbon economy needs to be both fair and inclusive in order to be real and to be lasting. Now, this is the three just transition elements, and the just transition is a key theme for all of our work at the Institute. Under the G7 presidency last year in 2021, the UK government supported the creation of the Impact Task Force, which was a global initiative aimed at promoting impact-driven economies and societies. And one of its work streams, which colleagues at the Institute were kind of running, focused on mobilising greater amounts of institutional capital towards a just transition. And as part of this work, the task force put forward this structure, three just transition elements that would allow the global community to speak with one voice, speak the same language when pursuing a just transition. And to advance a just transition, the actions taken have to meet all three elements. So the stool needs all three legs or it would topple over. So actions must advance climate and environmental action, including the reduction of greenhouse gas emissions and reducing air pollution. They must do so in a way which considers geographical disparities, the needs and priorities of different places, and that improves socio-economic distribution and equity. So that means improving the affordability of products and services. It means creating inclusive job opportunities, and it means facilitating a fair distribution of the climate change costs and benefits between countries, regions, and communities. And last but absolutely not least, those actions have to be carried out while kind of considering, or more than considering, giving a voice to underserved and marginalised communities, households, workers, enterprises, and giving those affected but often excluded a strong participatory voice through social dialogue and stakeholder engagement. Now, impact investing contributes towards a just transition when all three of those elements are integrated into investment vehicles and investment decisions. Now, I do realise that seems like a tall order, but as we'll see later on in the presentation, it is doable. And with the Impact Task Force report, there are some really great examples and a blueprint for future vehicles. So if you'd like more information, I can highly recommend chapter 3 of the Impact Task Force report, which has all of those kind of examples listed out, and we'll make sure that we make that available along with the slides. So we now get onto my small area of specialism, the thing I actually know things about. And we're going to take everything that we have learned so far about impact investing, and we're going to make it geographically specific. So at the Institute, the place-based impact investing program is working to make mainstream finance and get them to use place as an organizing principle for impact investment. Now, I'm not really fussy about how they get there. So maybe financial institutions are looking already to take a more intentional approach to place, and that's their starting point. For example, where their business was founded, even where they first opened their first office or their first franchise. And then they move from that into impact. They think about the needs of that place and they move into addressing them. That's great. Or maybe they're starting from a position of wanting to make a positive impact and then moving that into wanting to make an impact for a particular place. Either of those routes is absolutely fine. And there is an awful lot of capital out there. Some of it already impact driven, some of it not quite yet. But place-based impact investing is a way that that money can be used to address the challenges faced by underinvested places in the UK. But why? Before we get into some of the details of place-based impact investing, I always like to just take a minute and concentrate on why place-based impact investing is worthwhile. It's quite simple. It's because places matter. Where we live, the areas we travel through and between, how we got here, how we're getting home, they shape our lives. The places we rest, the places we shop, exercise, work, play, and meet each other affect our identities, but they also determine health and educational outcomes and define access to opportunity and to networks of social and community support. Well-designed, well-built, and well-maintained places help people to thrive. They can improve well-being and drive economic growth and prosperity, and also to reduce entrenched inequalities. And we will all have heard of levelling up. In fact, I mentioned it earlier in the presentation. And that's essentially what place-based impact investing is about. It's about putting the investment community at the very heart of delivering creative solutions to produce measurable benefit across a wide range of social outcomes. Because an economy that works for everyone requires an intentional approach to place. I'll stop evangelizing about place and tell you a little bit more about place-based impact investing. So essentially, we take those kind of categories of intentionality, of additionality, and of impact measurement that we learned about right at the top, and we add to them a kind of definition and selection of place, so a real intentionality about place. And we also add stakeholder engagement, which brings us back to those 3 just transition elements. So community voice has to be a really big part of this work. So financial institutions looking to invest for impact in places should be intentional about the places they're selecting. And as we mentioned, that can be for a variety of reasons. But they should also meaningfully engage with those places to establish what their needs are and set an impact goal. And that engagement should continue throughout the lifetime of the project. Great. I just wanted to give you a little bit of a flavour of some examples of the sort of sectors. So when I talk about place-based impact investing, what exactly is it? What transactions and kind of on-the-ground projects are we actually talking about? So there are investment opportunities in a range of sectors in affordable housing, clean energy, regeneration, small and medium enterprise finance, and infrastructure. And I won't go through all of them, but just as a kind of example, so when we talk about business finance, we're doing some work with community development finance institutions at the moment, who have a really good track record on women and minority-owned business lending, business support schemes, but also a low default rate. And so they represent a kind of good investment opportunity for those investors who are interested in creating place-based impact. Clean energy, one of my favourite examples of an impact investment, which is a little bit like the Sleaford renewable energy plant that we saw in the video. But in 2016, Nottinghamshire Pension Fund invested £1.5 million in Nottinghamshire Community Energy, which is a community benefit society, which has now completed construction on a 5-megawatt solar farm in Nottinghamshire, which generates enough clean energy to power over 1,000 local homes. They reinvest profits in the community and also ran a community share scheme, so it's part community owned. And that share investment is delivering a 7% return already. And then just lastly on infrastructure, so since I started this job, I've talked about very light rail extensions, about EV charging, fibre broadband, vertical farms, which are coming up actually, energy from waste plants, data centres, and kind of more other types of energy than you could possibly name. And so I guess the point there is that there's a lot of impact investing opportunities in place and in infrastructure that can really deliver really positive benefits for people as well as a financial return. So I'm going to stop for a tea break, mostly for myself at this point. But before I do that, does anyone either in the room or I've got the Zoom Q&A here, if anyone on Zoom's got questions before we break for tea. I don't think anyone. No, go for it. I'm just checking the Zoom one.
Do I really need a mic?
No, I can hear you. Oh, on Zoom maybe.
Oh, right. Okay. So everything we've talked about, it sounds like it's focusing on private markets rather than public markets because it's hard to prove additionality. Okay. I just wanted to confirm whether public markets have a role to play.
Absolutely, they do. So you've touched on one of the myths that we're going to bust in the second half, but it's not just private markets. There is a kind of focus on private markets because of the kind of direct nature of those projects, but there are a few kind of public market instruments that are doing really great place-based stuff, and we'll meet one of them in the next half.
Anyone else?
There is someone on the Zoom. I can't read it. Can someone scroll? I can't scroll. I'm just going to do this until something happens.
Can you?
Oh, yes, it's scrolling.
Okay.
The mechanism of the community share scheme. So I'm assuming this is a question about the Nottinghamshire Community Energy. So essentially, a portion of equity. Oh, sorry, yes. can you expand a bit about the mechanism of the community share scheme, which I think is in relation to the Nottinghamshire Community Energy Programme, and essentially a portion of the equity investment in that project was kind of set aside for community shares, and so they ran a kind of local fundraise, and local people bought shares. I think that answers the question. And then, are there any institutional grade green bonds that are also impact certified? So I think it largely depends on what you mean by an impact certification. The UK government issued green bonds, and has done it twice, I think. And those green bonds do include a kind of a measure of social impact within them. So I think the answer is probably yes, but we can check. Andrew on Zoom. I think that's it. So I'm gonna. Oh, sorry. Yes, go for it. I think we have to make you use the mic. Sorry.
Yeah, probably something for you to come to after the break. But could you say a little bit about certification measurement? Because there's a lot of controversy around particularly ESG and the sort of standards around that. In the environmental sphere, lots of issues around greenwashing, claims that are being made around impact and benefits. So just to hear your thoughts in terms of what's in place and what needs to be in place around that.
Yeah, absolutely. We can definitely do that. So one of the myths is, unsurprisingly, on impact measurement. So we'll touch a little bit on kind of impact washing in that as well. Was there another question?
Another question, yes.
Yeah, actually, I have about 32 acres near Lincoln.
Great.
So I want to do EV charging for electric vehicle, and also do some social impact housing on that area. Somebody was saying that 31st March, the EV charging, the grants is changing or something. Is that something true? Or?
I don't know is the short answer on EV charging specifically. But I imagine if you've got links into the local council in Lincoln, then they will know, and they'll be able to advise on kind of what would be most helpful on that piece of land, and what would kind of most usefully address local challenges. So definitely that would be where I'd point you to. Thank you very much, and I hope those of us here in person are suitably caffeined up. So, as promised, impact investing, myth busting is what we're doing in the shorter second half of the session. So as we talked about earlier, the kind of worst myth about impact investing is that it's somehow incompatible with a financial return. But there are several other myths that are prevalent and that we're going to talk about. I'm going to address these one by one, starting with my colleague Sophia's favourite. So again, a hello to her if she's on Zoom, which is the idea that impact investing is incompatible with fiduciary duty. And that we touched on that in the video we watched about pension investment, but just to touch on it again, there's another shorter video, and the big spoiler, it's not. But we'll watch the video just to prove it.
People used to think the Earth is flat. We now know that's a myth. But did you know that you can't actually see the Great Wall of China from space, or that Columbus never set foot in North America? There are plenty of other myths that still need to be debunked. Like the myth that impact investing means sacrificing financial returns. The truth is, impact investments look to generate positive, measurable social and environmental impact alongside a financial return. So how does this fit with pension trustees' fiduciary duties? The purpose of a pension scheme is to provide pensions for members, but this does not mean focusing only on maximizing financial returns. Trustees invest in all sorts of things for all sorts of different reasons. They might hold cash to manage liquidity or bonds to match liabilities. An investment in social housing could help diversify a portfolio, provide a steady stream of income, and reduce volatility. It could also have a positive social impact. in fossil fuels might have looked like an ethical decision. Nowadays, it is a financial decision. The world needs to adapt to a carbon neutral economy because of the negative environmental and social impacts of fossil fuels. Investments in fossil fuels therefore hold significant financial risks. But there are investment opportunities in this transition too. Pension trustees can make investments that have a positive impact, like renewable energy. Did you know that buying shares in a company was considered imprudent until as recently as the mid-20th century? It's hard to believe now, but rules limited pension trustees to making safe investments, like government bonds and mortgages. The understanding of prudence continues to change in step with societal norms and knowledge. Pension schemes are starting to go tobacco-free across their investments. This is a prudent response to the global change in social attitudes towards the tobacco industry. Countries are managing their negative social impacts by using regulation. That's why pension schemes like the University Superannuation Scheme and Nest believe that tobacco is a poor long-term investment for their millions of members. Fiduciary duties are actually an evolving body of duties. And are those duties a barrier to impact investing? No. Pension trustees can in fact use positive environmental and social impacts as an additional rationale for choosing investments that they believe will deliver financial value. To learn more, visit www.impactinvest.org.uk.
I always try and channel how cheery the narrator of that video sounds. So that's our first myth on fiduciary duty. Our second is on how hard it is. So lots of people just say it's too hard. So here are two examples of commercial asset, and we'll distribute the slides later, so you'll have the examples. But two examples of commercial asset managers who are delivering impact investments in the UK, and that's alongside people like Resonance, who I mentioned earlier. So Gresham House are a commercial asset manager engaged in place-based impact investing, and the vertical farms, which I'm obsessed with, so obviously have come up before, that they've invested in are kind of thriving, high-growth potential businesses which support good local jobs, as well as addressing the climate crisis, and also contributing to the UK's food security and independence. And then Foresight are another commercial asset manager who are industry leading in terms of impact and the way they approach it. Their work is scaling, and they've already got 5 regional funds investing in the UK. So I guess the point here is that, maybe it's a little bit harder. I'm not going to say that it's, not, but it is very doable, and people are having quite a lot of success doing impact investing. Our third myth, which we've touched on, actually, thanks to questions and a little bit in discussion over tea, is that it doesn't scale. I'm sorry, the blob is in slightly the wrong place here, but the impact investing doesn't scale and is only available in private markets. Again, not the case. And just one example that demonstrates that is the Schroeder BSC Social Impact Trust, which is a listed vehicle, so investable by any investor. It's open-ended and it's highly impactful. For example, it's already invested in specialist housing for survivors of domestic violence. The fund's targeting a net asset value total return of CPI plus 2% per annum, net of fees. And that might sound low, but crucial to note is that the portfolio is incredibly low risk. So risk is reduced in the trust's target investments because their underlying income is often inflation linked and government related. So for example, through social housing rents. The trust's assets are typically therefore less exposed to market and economic cycles than mainstream investments. So that's kind of a listed vehicle that is delivering impact as well as a financial return. Myth 4 is that impact, particularly social impact, is really difficult to measure, and that links to the question that we had earlier. So again, it is an additional kind of thing that you have to think about when you're making an investment and you're wanting to measure the impact. But it's worth saying that the Impact Management Project is tackling this issue and is a kind of aiming to be a one-stop shop for useful practical resources on impact measurement, management, and reporting. And there are also lots of other metrics available. And actually, without wanting to oversimplify it, a lot of this is about common sense and just getting started. And in relation to place-based impact investing specifically, we're about to publish a starter for 10 list of metrics that are measurable and that are reasonable for investors to collect information on for their underlying projects. In reflection on the question we had about kind of green and impact washing, I think that as we know, as we've seen, lots of responsible investments don't actually purport to deliver positive benefit. And instead, so they're not in the C, contributing to solutions category, they're in the A, acting to avoid harm category. And that is kind of, it happens a lot. And so the public doesn't understand the acting to avoid harm as a positive benefit, really. And that's absolutely right. So essentially, what we say at the Institute is that more transparent labelling of products enforced by regulators, as the FCA is actually seeking to deliver with its current work on product disclosures and labelling, will help investors make more informed choices about the investments that they're entering into. And investors, whether individuals or institutions, have a really powerful voice. And actually, especially through our work with pensions, for example, one of the things that we're encouraging is for investors to use that voice. As investors, as individual investors, but also institutional investors, have a right to expect asset managers to be able to demonstrate the positive results of their investments if they've committed to deliver those positive results, and they should demand that information when it's not providing. There are a number of initiatives to create greater transparency, harmonisation, and comparability of impact. So it's a really key area of activity at the global, regional, and national level in the kind of impact investing space. But the short answer is check out the Impact Management Project for lots of really useful and direct tools. And then finally, not so much a myth, really, more of a kind of barrier to impact investing, and that's a lack of knowledge and expertise. As I hope we've demonstrated, most of the common objections to impact investing are red herrings. And the growth of impact investing, though, is in the hands of investment professionals. And at the Institute, we're working with investment professionals kind of across the ecosystem to extend the sector's knowledge of impact investing and to better integrate it into mainstream training and education. Our online learning hub is a place for professionals looking to learn more about impact investing. And without wanting to blow our own trumpet, it was cited by Forbes as one of the world's leading go-to resources for impact investing. And this video is Will Goodhart, who's the CEO of the CFA in the UK and one of our board members, just to give you a little bit of a tour of the Learning Hub.
It's a place where you can find everything that you need to know about impact investing. It's a knowledge supermarket. The world of impact can be difficult to understand. And on the Hub, we break it down into logical sections and then provide you with the material to help you build your knowledge and skills around each of those different aspects of impact investment. It's incredibly convenient. We've brought together everything in one place, and it's also independent. The Impact Investing Institute is a not-for-profit body, so there's no commercial incentive for the information that we have on the Learning Hub and that we're providing to you. It's the single best curated resource of information, knowledge and skills around impact investing that we know of. It's for all of us. We're all learning about impact. Impact investing is such a dynamic and fast-moving market that we all need to build our knowledge and maintain our skills as this market develops. And what we've done is to bring together people who have built their own competence over the recent years, and we've asked them how they learned and where they turned for information. And we've taken that advice to build a learning journey that we hope is as easy, effective, and comprehensive as possible for you.
Great, so with thanks to Will, I'm actually going to skip this Menti in the interest of time, though I know that you know that it pains me, given how fond I am of the word clouds. But given what time it is, I wanted to just move straight to questions, really, and see if there were any in the room, on Zoom, anything people want to know before I leave you to the plenary session.
Any questions?
I have a practical question. How will they get access to the slides?
I will send them to the Financial Inclusion Forum, and I'm sure they will be happy to distribute them.
Okay.
I think also this has been recorded, so you should be able to access it, and we'll make sure there's a link to the slides in that.
Right. Thank you.
No. I don't think there are more on Zoom, but maybe it might need scrolling. But I think we're probably okay. In the Impact Investing Institute. So if you drop us a line on, well, so it's on our website, but info@impactinvest.org.uk, then someone with kind of what you're interested in and what about our work is particularly kind of relevant to what you do, then someone in the team will pick it up, and you can mention that you were here and that we met, and you can yeah, get involved that way. Would be great.
So it's info at
impactinvest.org.uk. I'm just going to check that's right. .uk, yeah.
Thank you. Good question.
Or I'm sure that the organisers can circulate my details as well. I'm really happy to hear from anyone directly. Or you can find me on LinkedIn. Mm-hmm. Or indeed the Institute on LinkedIn.
At the beginning of your presentation, you said that the Institute also had formulated some principles.
Yes.
And I'd like to hear more about that. And B, there is in the ecosystem of IMM, impact measurement and management, there is a plethora of principles, frameworks, etc., etc. And actually, one of the big challenges, I think, of the whole ecosystem is coming together. So why, I guess you must have felt that it was really necessary to develop an extra set of principles. But I do question sometimes that from all corners of the world, people come with principles and frameworks and all kinds of...
Yeah, the challenge of information overload.
It's yeah.
Yeah, absolutely. So the principles that we've created are specifically for kind of pension funds, and that was mostly less about their management framework and more about how they can include impact as part of their allocation strategies, which I think they were sort of, that's what we were hearing from the market, that there was a need for that particular.
Did you then do that, for example, in collaboration with PRI? Pension funds, then that's basically where all the ESG started.
Yeah, so we've got at the Institute, we've got a pensions expert panel, which I'm not totally sure of exactly who the membership are, but they are kind of sector leaders, and so they all kind of fed into that. So we were trying to sort of aggregate information from across the ecosystem. I think on measurement management and reporting, the impact management project is trying to do exactly that, and kind of its purpose was to aggregate all of the information into kind of a more digestible, really practically useful website, which they've done and which is looking good. The specific set of metrics that we've delivered for my program is on place, and so how you kind of attribute and measure kind of place-based impacts, which we did feel was slightly different from what's out there and is for a very specific kind of impact investor.
But you understand, if you're an asset manager and you've got a portfolio, and you've got, so asset manager has got a portfolio, has got some place-based focus. It becomes very difficult, I think, for an asset manager to across all the various ways of measuring impacts to to get an idea of where their portfolios stand?
Yeah, I think so. I think I understand it in that I'm not going to stand here and say that it's easy, and it is. Impact measurement is difficult, but I think it's hard to retroactively apply impact measurement. But if you set out to make impact investments and you have a very specific impact goal and a set of metrics that you're going to measure against from the beginning, then you take that through your whole strategy. So I think if you've developed an impact goal, you've decided what it is you're going to measure, and then you measure it almost, rather than, it would be difficult to say, we've got a portfolio, we want to kind of baseline or benchmark it impact-wise. You haven't made those investments intentionally, measurably, or additionally. And so that is, is hard to benchmark existing funds. We are doing it with a couple of local government pension schemes, with South Yorkshire and with the Vale of Clwyd pension fund. They're about to run their existing portfolios through our new place-based impact investing framework. And that process, as you say, it will be interesting because we'll be figuring out whether it works, what the kinks are, what issues we run up against. So I think there's not a kind of easy or quick answer, aside from saying that it is something that the kind of global community is working on, and we're trying to make it better. Yeah. But it is hard.
Thank you. But as you said, the key thing is you have to set out the metrics when you're starting. Yeah.
Oh, there's a question there. Yeah.
Hello. Really useful sessions. Thank you.
No problem at all.
Just really curious, how does Impact Investing Institute address on the negative impacts, since we all create positive and negative impact for all our actions taken? Do you have a standard approach you can share? Thank you.
Sorry, just so I understand, to mitigating the negative impacts of investments, or?
So I guess I'm trying to figure out, we've been talking about a lot of positive side of the impacts, but how do we address on the negative side of impacts, and it's still there,
Absolutely. So I think that there will continue to be investments made that have negative impacts. I guess with an impact investing approach, you are kind of constantly seeking to reduce those negative impacts, but also to make sure that there aren't unintended negative impacts, and to kind of really try and make sure that you're intentionally addressing the needs of a place, and so contributing solutions to a particular problem. And so I think that the more financial institutions move to an impact lens and an impact approach, the fewer negative effects of investments that we'll get. And there's not, I guess, a huge amount we can do about the negative ones that already exist, apart from having a really active voice as investors and shareholders, and making sure that we're trying to move to impactful allocation strategies.
Thank you.
Not a silver bullet, I'm afraid.
I just wanted to suggest an example of that, is that a very large pension fund decided to disinvest from fossil fuels. And so that's one way to start mitigating against a negative impact.
Yeah, I think divestment's really interesting, actually, and we saw it a little bit in the fiduciary duty video that was about divestment from tobacco firms. I think and I'm by no means an expert, I think the conversation around divestment is an interesting one, partly because oftentimes if large institutional investors divest from harmful investments, someone else in the market could well pick those up. And so there's some really interesting moves, organizations like Share Action, to kind of figure out whether divestment or becoming a really kind of active shareholder, turning up to annual general meetings and kind of demanding much better measurement of those negative impacts and mitigation of those, is a kind of also really positive way that we can move the dial as kind of investors and individuals. So some really, I'd really encourage you to have a look at Share Action, who are really, really interesting on this stuff.
And we do have an example now with so many companies divesting themselves from Russia.
Yes. Absolutely. Great. I think we haven't. I've put everyone on Zoom to sleep, so that's a good sign. I'll be around a little bit. So if there's any other questions, do just come and find me. But thank you very much for your time and attention. I hope it's been useful. You know, as we say, do find the institute. Do reach out. Do let me know if you've got questions that occur to you afterwards.
And thank you ever so much.
No problem at all.
Yes. So. This has been our first impact investment boot camp. So this is a wonderful way that you've inaugurated this with us.
Well, we'll come back whenever you'd like.
That's great. So thank you very much.
Great. Thanks, everyone.